Meet Leila, a diligent investor who tried the old BRRR method. Buy, renovate, rent, refinance. She struggled like we all do in trying to find the right property. Now she is stuck with hidden costs, unreliable contractors, and endless headaches. Then Leila discovered Clifton Homes and our upgraded BRRR method. Build, rent, refinance, recapitalize, reinvest, and repeat. No more construction loans or dealing with random contractors that don't perform and all the cost overruns. Instead, Leila is investing, buying new construction single and multifamily rental properties in a partnership with the developer, where she builds equity the entire way. Then leases the asset, refinances, and gets the investment back plus interest while still owning the rental property with the developer she partnered with. Leila got her money back quickly, plus she made money drawing interest along the way, and now she gets cash flow and 30% of the eventual sale of these assets, plus the others she is going to build in her partnership. Because what does she do with her money? Invests it again, continually building their shared portfolio. We do this at scale, from individual homes to entire neighborhoods, and have partnered with well-known institutional players like Invesco, Material Capital Partners, and other family offices. This is a proven model, not a one-off experiment. Let's break it down to just one house. You, like Leila did, invest $50,000 and now own the land or lot this home will be built on with the developer, and in about 5 to 6 months, the home is built and then leased out. By month 6 or 7, we refinance at around 65% loan to value. This returns your original $50,000 back plus 12% interest. And as a bonus, you still own that property with us, generating passive income from retaining 30% ownership in the stabilized asset. Which means you now have 30% of the equity, 30% of the cash flow monthly, and 30% of the eventual net proceeds at the sale of this asset. Look at what happens when you continue to reinvest the same $50,000 that has been returned after refinance and move into other units over and over. Accumulating just 22 units over the next 5 to 7 years estimates to a net over $2 million. When you are able to take the returned capital each time and use that same money to reinvest again and again, the multiplier of wealth is unmatched because every other real estate investment requires you to leave the cash you invested in the deal for a longer period of time before you can recapitalize. In this BTR investment program that we modeled after our institutional partners, you recapitalize your money faster, which allows for reinvestment much more quickly. This resembles the type of returns you see on a flip of an asset, yet you get this huge bonus of retaining ownership. Cash flow, wealth accumulation. Institutional buyers, like big REITs and insurance groups, are hungry for stable, newly built portfolios. In one larger subdivision, an $8.5 million equity investment returns over $50 million in 6 or 7 years. Thanks to lower cap rates at exit due to the aggregation of a few thousand BTR assets, investors pocket massive returns. It's a strategy that no other model can match. Run your side-by-side comparison between buying the biggest and best asset you could with a $50,000 investment, and the returns aren't even close. Since we own controlling interest in every single subcontractor, this allows for innovation. We control schedules, we value engineer the assets we build, we team trades up in ways that have never been done in the past. We do pre-production in our 50,000 square foot supply house where we build our own floor and roof trusses, have massive paint booths and pre-paint doors and window casings, pre-build components, pre-stain mantles and handrails, which all reduce the time frames to build and reduce the interest carry and risk. Our vertical alignment allows us to lower costs even further. We are able to pay our subcontractors, who we own, less money due to the alignment of interests, efficiencies generated, and teaming for the benefit of all. The lower cost to build each unit, the faster we build, both decrease the risk to nearly non-existent as we have margins others cannot match. And all of this equates to building assets below 65% of the value of those single or multifamily units. Then when we put tenants in those assets, we refinance them into permanent, and just like if we sold them, the investment in is returned 100% plus your 12% interest. Now, your investment isn't in a syndication or fund. You are buying actual assets that we are building on in a partnership. We sign an operating agreement for our mutually owned LLC and then deed the assets you are buying a portion of into that LLC. You are preferred stock, so your cash investment is returned first before Clifton Homes returns ours. The first bonus here is that you still own 30% of our mutually owned rental properties or entire subdivisions, and getting the cash flow plus the eventual exit when we sell these assets. And even though your capital was returned already, plus your 12% interest, your net worth went up because you own 30% of the 35% of equity we have in the stabilized assets we built together. For a quick example, on a $100,000 investment into two single-family houses, when they are complete, we have total equity of $280,000. You have 30% of that, which is $84,000. Counting the interest earned during the construction and lease-up period, you doubled your money in less than a year. For a quick example, let's say we build 20 units, and when they are complete, they are valued at $5 million. We refinanced at 65%, which is $3,250,000. At the refinance, your initial investment of $800,000 was returned plus the $85,000 you earned over the 11 months it was being constructed. You didn't just get your money back and the interest, since you still own 30% of this cash flowing asset that has $1,750,000 of equity in it. Your net worth just went up 30% of that $1.75 million, or $525,000. But it gets better, because with that money returned, you can reinvest into another asset. And 2 years later, in this scenario, you get your capital returned again, plus your interest, and now you own 30% of 40 units worth over $10 million. We have over 35% equity in these assets, and your net worth has gone up over $1 million. But don't forget about the cash flow. You are now getting mailbox money from these 40 units and 30% of the net, which estimates to over $4,500,000. And that's just 40 units. Why would you stop there when you could reinvest again and continue to accumulate, or as we say, stack your units and your wealth? We own our own lumberyard and supply houses, which means we buy direct and reduce the cost of the asset. Buying from manufacturers overseas, our lumber direct from lumber mills, and reduce the cost so dramatically that it nearly removes all risk. The large margin between cost and the end value, plus the fact that you own the asset and your money is the first money out, makes this an easy decision. With in-house engineering and architecture, we get through entitlements more quickly, value engineer for better efficiency and reduced cost, and most of all, since we are the sponsor, the developer, and the builder, and don't charge any fees along the way, this immediately reduces the cost by close to 30% of any other builder. No personal debt, no signing on loans, no endless wrangling with contractors, just stable growth, insider-level returns, and a partner who handles the heavy lifting. We're building these assets under cost, so you're always in a safe equity position. Ready to see the numbers yourself? Download our detailed pro forma to see how double-digit IRRs are not just possible, but proven. Or schedule a call, no pressure, just clarity and options. Act fast, at prime opportunities go quickly.